Welcome back to the Deep Dive. Today, our mission is really getting under the hood of Blackstone's Q3 2025 investor materials.
Right. We're talking about the world's biggest alternative asset manager here.
Exactly. And it's more than just numbers, isn't it? It's about tracking where they think the big structural shifts are happening in the global economy. That's the goal of this deep dive.
Yeah, and this quarter is particularly interesting. It's their 40th anniversary this month, for one.
40 years, wow.
And the data really shows, a new phase of growth, new capital channels powering things.
Okay.
But before we get into all the financial wins, it's important to mention something from the investor call opening.
Yes, absolutely.
They acknowledged the tragic shooting at their New York offices back on July 28th. And the loss of their colleague, Wesley Lopaner. It was a very somber, necessary moment that, set a certain tone.
It did. Acknowledging that loss was crucial.
Yeah.
Okay, so pivoting now to the scale of their operations. The headline figures are pretty staggering. Industry records, really.
They are. Assets under management, AUM, hit $1.24 trillion.
Trillion. Just let that sink in.
Yeah, and that's up 12% from last year.
But the number that really jumped out, I think, was distributable earnings, the DE.
Oh, absolutely. That acceleration was huge. DE was up nearly 50% year over year.
50%.
Yeah, hit $1.9 billion, which works out to $1.52 per common share.
So that massive jump suggests more than just steady growth. It feels like they're really hitting their stride on maybe realizations, cashing in.
That's a big part of it. It suggests the cycle is turning. They're able to exit investments, monetize that performance at a rate we just haven't seen lately.
Okay, let's unpack that a bit. DE is great for shareholders, shows what they can distribute. But it can be lumpy, right? Depends on timing the market.
True.
What about the sort of bedrock earnings, the more stable stuff?
Right. So for that, you look at fee-related earnings, FRE. That's the management fee income. Much more predictable.
And how did that look?
Also very strong. FRE grew 26% year over year, came in at $1.5 billion, or $1.20 per share.
26% growth in fees is still really high.
Yeah.
Faster than the AUM growth, actually.
Exactly. And that's structurally important. It tells you they're likely moving into higher fee products and just generally growing that reliable base faster than the market alone would lift it.
Makes sense.
Yeah.
But back to that DE jump you mentioned, realizations. The materials seem to signal a real turning point for sales, for IPOs.
They did. Net realizations were more than double the same period last year.
Double, wow.
$5.05 billion in the quarter. Now, part of that came from 3 IPOs that went well,
Okay.
but a significant chunk also came from selling an interest in their GP stakes portfolio.
Right, GP stakes. Maybe quickly explain that for listeners who aren't deep in the weeds on all.
Sure. So GP stakes means Blackstone buys minority stakes in other private equity or alternative investment firms. The general partners, the GPs.
Ah, okay, so they invest in their competitors, essentially, or peers.
Sort of, yeah. They buy a piece of the management company itself. So when they sell that stake, they're cashing in on the value of that firm's future fee streams and performance. It's quite strategic.
Got it. Very meta. And realizing gains now builds up potential for future distributions, right? Their store of value.
Exactly. That's the net accrued performance revenues. It's money earned but not yet paid out.
How big is that store?
At the end of Q3, it stood at $6.5 billion, about $5.30 per share. So substantial future potential there.
And to make future investments, they need capital ready to go, the dry powder.
Yeah, and the war chest is, well, massive. Total dry powder available is $188.1 billion.
Just enormous. $188 billion. Okay, so where is all this new money coming from? Because the inflows are also huge.
They really were. $54 billion in inflows this quarter alone.
And that's the 4th quarter in a row, over $50 billion.
That's right. Consistent, large inflows, and the drivers are becoming clearer. It's really about specific channels showing structural growth.
Outside the traditional pension funds and endowments.
Yeah, largely. First is private wealth. Individuals, high net worth investors.
How big is that now?
AUM there has tripled in just 5 years. It's nearly $290 billion.
Tripled. Wow.
And the momentum is strong. They raised $11 billion just in Q3 from private wealth. That's the best quarter in over 3 years.
In any particular product leading that charge?
BCRED was a standout, their private credit fund.
BCRED. Blackstone Private Credit Fund.
That's the one. It pulled in $3.6 billion. It really shows that individual investors globally are still actively seeking yield, moving into alternatives like private credit, diversification too.
Okay, so private wealth is one major engine. What's the other big channel?
Insurance. That's become a behemoth.
Right? How are the numbers there?
AUM grew 19% year over year. It's now $264 billion.
Also huge. And what's the strategy within insurance?
It's interesting. They talk about an open architecture, multi-client approach now, meaning it's not just a few giant mandates anymore. They have 33 different strategic relationships and separate accounts. And the key thing is nearly 2/3 of their existing insurance clients actually expanded their relationship in the last year.
That shows real confidence,
Yes,
stickiness.
definitely. They're providing bespoke solutions these insurers want.
Looking forward, the materials mention something with massive potential. The U.S. defined contribution market, 401ks.
Yeah, that's kind of the next big frontier everyone's watching.
What's the thinking there?
Well, there was a recent executive order, and the expectation is that the regulatory doors will eventually open for alternative investments like private equity or credit to be included in 401k plans.
Which is a multi-trillion-dollar market.
Exactly. Massive potential, like they said. And Blackstone's positioning itself now. They've already launched a dedicated DC business unit.
Getting ready for when the floodgates open.
Pretty much. They want to be there first, offering diversification and returns that, maybe standard mutual funds can't match.
Okay, let's shift gears. Let's talk defense and deployment. The report was quite direct about the significant external focus on credit defaults lately.
Yes, they addressed it head on.
What's the distinction they're drawing between those headline defaults and their own huge private credit business? It's over $150 billion, right?
Right. Their core argument is the defaults making news were largely in bank syndicated credits, not traditional private credit.
Okay, what's the difference in practice?
They argue those bank deals sometimes have looser standards, maybe less due diligence, sometimes even issues with collateral. Their model is different. They originate the loan directly, they control the covenants, they do deep underwriting, and they hold it.
More skin in the game, essentially.
You could say that.
Direct control.
But they need data to back that up, especially with default rates. They quote that 0.1% annual realized loss rate since inception, which sounds incredible, almost too low, especially since it includes the GFC.
It does sound low. Is that low rate sustainable now that interest rates are much higher?
Yeah.
Wasn't it partly a result of the zero rate environment?
That's the key question everyone asks. They argue their structure has built-in safety features that make it resilient.
Like what?
Two main things. First, over 95% of that $150 billion platform is senior secured debt.
Meaning they're first in line to get paid back if things go wrong?
Exactly. Top of the capital stack. Second, and this is crucial, the loan-to-value ratios, the LTVs.
Tell us about those.
They state the average LTV is less than 50%.
Okay, so if they lend $50, the asset is worth at least $100.
Right. That 50% plus equity cushion below their debt is the buffer. It means the asset value could drop, say, 40% or even 45%, and their loan principal would still theoretically be covered.
That's a big margin of safety.
That's their argument for why that very low historical loss rate is potentially sustainable. It's built on that conservative structure.
All right, so with that discipline and nearly $200 billion in dry powder, where are they actually putting money to work now? What are the big themes?
Very thematic deployment. Two areas really pop out from the materials: infrastructure and energy, and data centers.
Okay, infrastructure first.
Big move. There was a $7 billion venture with Sempra Energy.
What's that for?
It's funding the construction of an LNG, liquefied natural gas export facility, long-term project on the U.S. Gulf Coast.
So playing into global energy security needs.
Absolutely. And it seems to be working for them. Their infrastructure funds were up 5.2% in the quarter alone.
Nice return. And 19% over the last year.
Yep, strong performance.
Okay, and the second big theme, data centers. Driven by AI, presumably.
Completely. But their strategy is quite specific, focused on managing risk.
How so?
They're not betting on which AI company wins. They're building the essential physical infrastructure, the data centers themselves. Then they lease them out long term.
To who?
To the big investment grade tenants, hyperscalers, major cloud providers. And the leases are typically long, like 15 to 20 years.
Ah, so they build it, but then lock in a reliable blue chip tenant for decades.
Exactly. It de-risks the massive construction costs, turns it into something more like a long-term bond-like income stream. Predictable, contractual cash flow.
And is the demand there?
Apparently, yes. They said their global leasing pipeline for data centers doubled in Q3 compared to Q2.
Doubled in one quarter.
That's what they reported. Shows just how fast the demand for computing power is ramping up.
Incredible. Okay, speaking of acceleration, let's zoom out to the wider market. The deal cycle seems to be turning. IPOs are picking up.
Yeah, the report confirmed that. Global IPO issuance more than doubled year over year in Q3. The logjam seems to be breaking.
What does that mean for Blackstone's ability to exit investments and return cash?
It's obviously positive. Better markets mean potentially higher valuations, easier exits. The CEO actually mentioned their internal IPO pipeline.
Yeah,
He suggested that if the deals currently lined up for the next 12 months actually happen, it could be one of the largest years of issuance in Blackstone's history.
that would certainly fuel more distributions and maybe more fundraising. It's a cycle.
Yeah.
All right, one last big area, real estate. Just a tough couple of years for CR. What's the latest check-in from their perspective?
The picture they paint is maybe mixed, but definitely improving. Signs of bottoming.
When do they think the bottom was?
Their internal view is that commercial real estate values likely troughed back in December 2023.
Okay. And how are their big funds like Bright holding up?
Stabilizing. Their core plus funds, which includes Bright, were up slightly, 0.6% in Q3, and they highlighted the long-term picture. The main Bright share class still shows a 9% net annualized return since it launched.
Still, the worry for many is oversupply in commercial real estate. Why are they optimistic values will recover?
It really comes down to supply fundamentals, interestingly.
How so?
Because financing got expensive and uncertainty was high, new construction projects basically ground to a halt over the last couple of years.
Fewer new buildings starting.
Dramatically fewer. They noted new construction starts for U.S. logistics and apartments, two of their biggest sectors, are at the lowest levels in over a decade.
So less new competition coming online down the road.
Precisely. When demand eventually picks up, or even just stabilizes, the existing high-quality properties won't face a flood of new inventory. That should support occupancy, rents, and ultimately, values. It sets a positive foundation.
Okay, so wrapping this all together, we've got accelerating earnings, huge inflows from new channels like private wealth and insurance, disciplined deployment into these big mega trends like AI infrastructure, energy security. What's the main theme you take away from this quarter?
I think the central idea is scale being used strategically. They're moving beyond just being a collection of strong investment silos. They're aiming to be the dominant partner, providing, holistic multi-asset solutions for big clients globally.
So less about individual funds, more about integrated platforms.
Yeah, their leadership seems built on organically growing these huge platforms: credit, logistics, infrastructure, data centers. These all need integrated capital, equity, and debt at massive scale. It's about funding transformation, not just buying assets.
That focus on holistic, multi-asset solutions definitely feels like the future for these mega managers. And they flagged 2026 as potentially their busiest year ever for new product launches aimed right at that complex integrated space.
Right. Which leads to maybe a final thought for you, the listener, to chew on.
Okay.
Given their incredible scale, this focus on complex solutions powering AI, energy growth in places like India, what huge global challenge might these massive integrated multi-asset strategies be designed to tackle next?
Thinking beyond just financial returns.
Maybe. Think about climate transition, global urbanization, resource scarcity, problems that need enormous coordinated deployment of different kinds of capital and expertise all at once. What could that look like?
Definitely something to ponder. A fascinating look inside Blackstone's Q3. Thanks for walking us through it.
Glad to. Until next time.